Good evening, students. My name is Devas Gupta, and today we will be covering the topic of risk analysis in capital budgeting. Yeah, so let us start. So first of all, students, risk analysis in capital budgeting, if we see, till now we have covered the capital budgeting basic things, correct? Now, if we say capital budgeting is always concerned with two things, broadly two things. One is cash inflows. Second one is cash outflows, correct? That all of you would have till now studied. Now the risk, what is risk actually? If we understand this entire terminology first, so there in normal layman terms also, there can be three types of situations to understand risk. I'm now explaining risk because all of you would have preliminary knowledge on capital budgeting, right? So if I say that what is a risk, so I am explaining three situations through which we will be able to understand on risk. Okay, one is certainty. One is risk. And the last one is uncertainty. Now, what is certainty? Certainty is something in which the outcome is already agreed and fixed. We know that in future, or let's say tomorrow, day after tomorrow, or 10 days from now, in future, this event is going to happen. This cash flow is going to happen. This sales is going to happen. So if there is 100% surety of any event that is going to happen, that is called as certainty, correct? And an example of this will be if there is a legal agreement, correct? There is a legal agreement. Now think that there is a company called A Limited and it is selling some consumer products. Now it has a legal agreement with one of its customers to supply those consumer products to them. So then that cash flow of sales is bound to happen. There is 100% surety that the sales will happen, correct? Because there is a legal agreement to it. So hence we can say that the cash flow is certain and hence there is a 100% certainty. Now, this is certainty. What about risk then? So risk is a situation where you don't know that what is going to happen in future, but you can measure in some probabilities. For example, now if we talk about cash inflows, right? So there are 3-4 possibilities that are there. Okay. What are those 3-4 possibilities? Let's say first possibility is 2000 rupees. I'm talking about cash inflow 1 year from now. Gajjar is asking, we are not able to see class on app. Please restart the app once because I'm not getting this query from anyone. Please check it at your end, Gajjar, again. Tanu is, okay, good evening. Sushil is asking 2 minutes late. No issues, Sushil, we have just started. So don't worry, we have just covered that we are going to cover risk analysis in capital budgeting. Capital budgeting is all cash inflows and outflows, and risk analysis is what I am trying to explain now. The term risk I am trying to explain now, in which I have already explained that what is certainty. Certainty is 100% surety that this is the outcome, correct? What is a riskier situation? What is risk? Or we can say risk is basically you don't know what is going to happen, but still you can estimate that what are the different possible scenarios. For example, the cash flows from 1 year now, 2000 rupees, it will happen. There is a 20% probability, correct? Similarly, for 3000 rupees, let's say there is a probability of 30%. For 5000 rupees, there is a probability of, let's say, 40%. And for 1000 rupees, there is a probability of 10%. So 100% is the probability. And these are the different scenarios that we are talking about, right? So only 20% chance is there that 2000 rupees would be the cash inflow. Now, this is called as risk. Why? Because there is a risk that ultimately the cash flows will be 1000 rupees also. Just a second, students. I'm getting queries asking on the app. Technical, can you just check once, because students are saying on the app they're not able to see the current class. Yeah, yeah. So I'm pausing for 2 minutes. Let us see once. So students, now if you're able to see on app, just please, I would request all of you to please post it on the question handle that you are able to see, so that we can go on. I think Tanu is saying that we can see. Gajjar is also saying we can see. Okay, we can resume, I think. Yeah. So what I was saying is that risk is a situation where the outcome is not certain, correct? And there are different possibilities and there are different probabilities. There are different possibilities and there are different probabilities, correct? Now, there is a third type of situation. So this second type of situation, which I just discussed now, which is risk. So these situations will be there in which there will be different possible outcomes. So please remember this term, possible outcomes, with some probabilities, correct? Now, uncertainty is what? Where no estimate can be done. We are totally not sure what is going to happen, either on the cash flows or on probability also. We cannot even estimate the different scenarios. That is called as total uncertainty. Now, the example of this is, let's say, if we are launching a new product. If an established company is launching a new product, then definitely they will not be able to estimate that what is actually going to be the cash flows in future from the sale of those products, or what is the probability of different scenarios. Correct. The main part or the relevant part in this three situations is the second part, which is the risk, because the entire discussion will revolve around risk. Okay, students. Now hear me out. So there is a question from Mancha. To ascertain the startup estimated cash flows, we shall have to consider probability of success or failure is equal to formula would be probability of success into cash flows. Am I right? Okay. We'll come to the formulas, Mancha. Okay. We'll come to the formulas. Let me first introduce the concept of risk to all of you, right? And we will see that how the formula is going to calculate. Okay, students. Yeah. So I'm taking the second scenario further now. So second scenario, can we say that what is the average cash flow? If I ask you what is the average cash flows here, what you are going to do is you're going to multiply with the probability and doing a total of it, correct? That is called the weighted average simply. So let's say the average cash flow is equal to 3400. Okay. Average cash flow is 3400. If we just simply multiply the respective cash flows with their probabilities and take a summation of it. Is this piece of information useful to you? Or I will again put one more information in a more professional way. I will say that average cash flow is 3,400. Now think that you are actually you are actually reviewing the calculations, or you are actually evaluating a project, right? Think it from that angle. So I tell you that, see, the average cash flow in the next 1 year for this particular project would be 3,400. And also I'm giving you one more piece of information that there is a risk of this cash flow going up or down by, let's say, 500 rupees. So this is the additional information that I've given to you. Now, what is this? Definitely, you will feel more equipped to take any decision making if you have the average as well as the risk, right? You will feel more data, right? But here in the first point, you only know that what is the average. That is the normal part. But what if I tell you, because in the practical scenario, there will be a risk, right? You cannot estimate it properly. And that's the biggest thing. Now, if you know that this is the average and this is the risk of plus minus 500, then you can certainly say that the cash flow will fall somewhere between this range. What is this range? 2,900 to 3,900. So basically 3,400 minus 500 and 3,400 plus 500. You can easily conclude that, right? If I tell you that apart from the average of 3,400, there is a risk also of the cash flow going up or down by 500. So you will say that, okay, the cash flow can be anything in between 2,900 to 3,900. And hence, you will try to simulate now the different simulations of the capital budgeting, right? You will try to assess. You will say that, okay, what if I get a minimum cash flow, 2,900? Then is the project viable? Or you will say that, okay, what is the maximum upside gain that I can have, which is around 3,900? Is the project viable at 1,300? Or what is the type of return that I'm getting? Similarly, this 2,900, you will do the same analysis. Okay. I hope the intent, I hope the purpose of studying this topic is very clear. Correct? Now, I have mentioned these two terms, average and risk. Okay. Now, the entire topic will revolve around these two things only. Now, what is average? I am linking it to the technical statistical terms now. Correct? This is the layman understanding that we have created. So average is what? Average is mean. Simple. And risk is what? Risk is standard deviation. I will prove you how. Okay. Okay. So I'll tell you. First of all, if you see average, average is nothing but the mean, right? We have just taken the weighted averages multiplied with the respective probabilities, and that's the average. Average is generally the mean. What is risk? Risk is the possibility of possible outcomes deviates from actual outcome. See, what is risk, students? Now, risk is simple, that I estimated that cash flow should be 1,000 rupees. This is my possible outcome. But actual outcome is what? Actual, it is only 800. Can I say that there is a risk, right? And how to measure that risk? Risk is nothing but the deviation of these two, 1,000 and 800, right? So hence, to term it, we are saying it is a standard deviation. Now, standard deviation is calculated how? Xi minus X bar raised to the power 2, right? This is for variance that we do. which is SD square, right? And we will take a summation basically of all these observations multiplied by the Pi. I is equal to 1 till n. Whatever is the number of observations, that's how we calculate the standard deviation. Or we can say it is a variance. So if you see, this is a deviation from the deviation of the possible outcome, which is xi, from the actual outcome. Now, in this case, actual outcome we assume to be the average, which is the mean. Correct, students? Now, first of all, I will put the fair formulas as well for all of you to note. But as of now, just concentrate on the concept building first. Okay. Now, the probability. We have mentioned something about probability. Now, let us elaborate this term. What is a probability? Probability is what? Chance of an event occurring, right? What is the chance of an event occurring? As we all know, it lies from 0 to 1. Either something will have a chance of 1, that is 100% chance, or something have a 0% chance, which is 0, or something will be in between. Correct? And it is always for the forward-looking approach. So always when we talk about futuristic data, probability will be there, right? Forward-looking approach. Now, if we say that there is a probability, right? So technically we don't say that it is a average, right? We say that what is the expected value. Now, what is expected value? If we multiply the respective observations with their probability and sum it up, that is called as expected value in case of anything, whether you are given a data of cash flows or whether you are given a data of anything. Correct. Now, in this also, I'm putting it expected net cash flow. And the second one is expected net present value. So students, please listen now very carefully. So I'm saying that expected value is a concept which is applicable on any set of data. On any set of data. For example, if you are given a data which have the students, let's say, weight or students' heights in centimeters and or anything, and you are given some sort of a probability, you have to just multiply with the probability and take a summation of it, you will get the expected value. In our capital budgeting, we are going to use these two terms, which is expected net cash flow and expected net present value, which means that we would be given the different cash flows along with their probabilities, and we have to just arrive at the expected net cash flow. Formula is also very simple, right? So net cash flow, whatever is the net cash flow for ith observation. I means different observations and probability of that observation, where we will say I is equal to 1 to n. So 1 to n means whatever, let's say you have given 10 observations. So for all the 10 observations, you take the cash flow, multiply with the probability and take a total of it. Simple. This will give you expected net cash flow. Now, expected net present value is what? Expected net present value is the present value of the cash flow. Simple. So in this case, the formula will be expected net cash flow divided by 1 plus K is what I'm taking the discount rate, correct? Raised to the power T. I think from the knowledge that we have gained in capital budgeting, we know that how to do the present value or the future value, right? If we have to do the present value, we have to divide it by the 1 plus discount rate. And raised to the power T means for how many years it is. If it is for 1 year, we will put T is equal to 1. If it is for 2 years, we will put T is equal to 2 and something like that. Where t is equal to 1 to n. For all the years, we are going to do the expected net cash flow first, and then we are going to take the present value. Don't worry, students, we will solve enough and more questions to understand these things. Okay. Now, there is a term called standard deviation that we have understood. There is a term called variance. Okay. Now, what is variance? I will tell you a very specific thing, which is why we are using variance. Okay. And some of you might be knowing also. Now, in my previous example, I said that there are different cash flows, right? 2000, 3000, 5000, and 1000. Correct? Now, if your average, or let's say mean comes out to, let's say, 3500, for example, right? So what I said is, what is standard deviation? Standard deviation is the deviation of the possible outcomes from its mean. Correct? Because why we are taking mean? Because mean is the best expected outcome, which is the expected value itself, right? That is what the mean is. So if I do here, it means that 2000 minus 3500 I have to do. Similarly, 3000 minus 3500 I have to do. 5000 minus 3500 here I have to do 3500, and 1000 minus 3500 I have to do here. Now, if you see, this is negative, this is negative, this is positive, and this is negative. So ultimately, whatever comes, the negatives will get set off by positive, and it will not give you the true deviation. Reason being, the negative deviation should also be counted as a deviation. Not, see, because if you are getting positive here, so from this positive, these negatives will go and get adjusted. So hence, what we do is, we just do this 2000 minus 3500 raised to the power 2. Because if you take a square, the outcome will always be positive, right? And hence, then we take a total, and hence it will give you the correct deviation. Whether it is a negative deviation, it will also get counted. If it is a positive deviation, it will also get counted. There will be no set off in between negatives and positives. I hope this point is clear. Now, if we derive the formula from here, what is variance? Variance is generally denoted by this sign. Okay. Variance is basically net cash flow of the ith observation, correct, minus expected net cash flow. This is nothing but the mean, correct? Expected net cash flow we have just now calculated. We have just now seen how to calculate this one, which is nothing but the mean cash flows, right? And we will take a square of this for the reason just now I explained, multiplied by the probability of that particular observation. And once you do this, then you take a summation for all the observation put together. This we have just now seen. This is average / mean, whatever we can say. This is what the variance is. And the standard deviation is equal to under root of variance, which is this. So this term, if we say it is a standard deviation. Now students, again a beautiful observation. Now if you feel why I have mentioned here plus minus, I will go back here. In the risk I have mentioned plus minus 500, right? So what happens if you open a square root? Let's say the variance is, let's say 100 rupees or 100, whatever it is. So standard deviation will be square root of 100. What you will write? You will write 10, or you will write plus minus 10, correct? Because that's again a thumb rule that we have already studied earlier in the mathematics, that once we open a square root, there will be a possibility that minus 10 into minus 10 will also be 100. Plus 10 into plus 10 will also be 100. So we have to take both the possibilities, and hence standard deviation is risk. And hence I have taken the plus minus values in my previous example. This one. Okay. So SD is equal to risk is equal to under root of variance. Simple. So risk is always this. Yes, Vasu, that's right. Okay, Gajar, I'm just revising the concepts, even if we know, but let us just revise this. Okay. Sure. Now let's move forward. Okay. So I think till now, we know that risk is equal to standard deviation and the expected net cash flow is equal to the mean of those cash flows. Now, students, I am posting one question here. It's a very interesting question. Okay. Now let us see, and I will invite some of the good answers from all of you. You guys tell me after thinking over it, what is better here. So let's say there are two projects, projects A and project B. Now I'm coming back to the capital budgeting, right? There are two projects currently under evaluation. The average cash flow. While I say cash flow, read it as cash inflow, right? So average cash inflow, I'm saying net after reducing the outflow is 500 here and 1200 here. Which one will you prefer? Obviously, the answer is very obvious. You will prefer 1200, right? Because in this, the average cash flows is higher, correct? Although you will do the NPV first and then you will see what is the NPV coming out to be. That's okay. But if I give one more additional information, if I say that there is a risk of, again, I'm just ignoring this plus minus sign now, okay? That is for the understanding. So I'm saying that there is a risk of 100 here and there is a risk of 120. Now you tell me, students, which project will you prefer? Post like project A or project B along with the reason. Thanks, Jamil. Thank you. So what I'm trying to say is that there are two projects. Till now, we have studied that average cash flows is 500 and 1200. Now I'm introducing a concept of risk. I'm saying that there's a risk of 100 in project A, which is a lesser risk. Risk of 120 in project B, which is a higher risk. Can you tell me which project will you prefer? And why? One more thing here, students. Meanwhile, you think and plot. Higher the standard deviation, higher variance will lead to higher standard deviation. I think all of you will agree, correct? And higher standard deviation means higher risk. I have got some very good answers. Okay, let me see. Abhijit Singh is saying project A. Okay. Hina is saying B. Abhijit is saying because project A is a less risky project. Very good. Charu is saying project B as the risk is 10% and A it is 20%. Very good, Charu. I will come to Charu again. Gajar is saying project B. Shivam is saying project B because the risk is very low in comparison to the cash flow. That's right, Shivam. Mansha is saying project A, risk is less as compared to project B. Saurav is saying project B. Okay, now let me conclude this. So students, I think all of you are thinking on the very similar lines. Now let us integrate that thinking, okay? So if you see students on a standalone basis, if you are not given this information of the cash flows, let's say I am not telling you anything on the cash flows, definitely I will choose project A because there is a lesser risk, correct? But you have to see the risk in relation to the cash flows, right? Although there is a higher risk here, but the expected cash flow is also higher, right? So hence, we cannot compare it like this. What we have to do is, we have to just find out a formula here. What is that formula? If I do SD divided by mean, which is 100 divided by 500, similarly 120 divided by 1200, how much it will be? 20%. It is 10%. Even if I don't want to put in percentage, I can simply say 0.20, 0.10, right? Now, what does this ratio mean, students? SD by mean, what does this mean? For 1 unit of mean, what is the risk that I'm carrying? I'm repeating it here. 1 unit of mean, what is the risk that the project carries? Okay, students. Now, this is a very beautiful thing. So, if this ratio is higher, that means for 1 unit of mean, I am carrying a higher risk, right? If this ratio is lesser, that means for 1 unit of mean, I am carrying a lesser risk. Using this, we can say that 0.20 fetches you higher risk for 1 unit of mean. But for the same 1 unit of cash flow, which is the 1 unit of mean, you have to undertake a risk of only 0.10, 0.10, which is actually better. So hence, this is the professional analysis, right? I mean, all of us would have thought some other things or this thing, but how do we should think is that in this case, since both risk and mean is given, so let us calculate a term called coefficient of variation. Coefficient of variation. What is this coefficient of variation? This is nothing but SD divided by mean. This is just now we calculated, and I hope now all of you know that what is the reason behind calculating the coefficient of variation. Although the risk will be higher or lower, but we have to see it in relation to the cash flows or in relation to the average mean. Correct? Then only we will be able to understand that what is the real risk analysis in that particular project. Okay, I have got a lot of answers and I am very thankful that all of you are participating here. So yeah, I think Judith, lesser risk A. Okay, we discussed A, B, higher risk. Jamil is also right. Tanu in project B, yes. Kushi, yes. Kushi, yes. B. And Vasu, what is meant by 1 unit of mean? Okay, now Vasu is asking what is meant by 1 unit of mean. Now, students, again, this is a very beautiful question. Now, if you see, students, again, this is a very basic thing. Now, let's say we have a data set, correct? And what is that data set? Yeah, we have a data set, and that data set is actually showing weights in kgs, or that data set is basically in rupees. Let's say amount. It can be anything, right? Data can be in any form. Since we are studying capital budgeting, it is always in rupees amount, correct? While we will do an operation on this and calculate mean and standard deviation, so the unit of for this mean and standard deviation will be always the same what is there for the data set. If it is a weight in kgs, the mean also will be coming in kgs and standard deviation will also be coming in kgs. If it is in rupees, the mean also and standard deviation also, both of them will come in rupees. Okay, students. So 1 unit of mean, Vasu here means is that for 1 rupee of cash flow, what is the risk that I'm taking? In project A, I'm taking a risk of 0.20, and project B, I'm taking a risk of 0.10. So project B is better, right? Mancha is saying, but sir, risk and return go hand in hand. Okay. So let me explain that again. So Mancha, you are right. Risk and return goes hand in hand. If higher is the risk, higher would be the expected return. Correct. Here what we are talking is expectation from the person who's undertaking the risk, right? So hence, in this case, you see higher is the risk, right? And the return is also higher, but in not in the same proportion. That's what I'm trying to explain, Mancha. See, risk has gone from 100 to 120 and cash flow has gone from 500 to 1200. The proportion is not same, although higher risk means higher rewards. Okay. So finally, I can say that we know the probability. Now, what we have understood till now, we know this is the probability. Using probability, we can find out variance. Using variance, can we find out standard deviation? And using standard deviation, can we find out coefficient of variation or variance, whatever it is? Coefficient of variance. Not variation, we can put coefficient of variance. Okay, students, now let us go to the question number 1. So this is already uploaded, students, in the assignment part. So please download it and refer the question number 1 from that. Probabilities for net cash flows for 3 years of a project are as follows. Cash flow 2000, 4000, 6000, 8000. There are different cash flows that are given. Now, these are the possible outcomes, right, students? These are the possible outcomes. What is the possibility of 2000? 10%. Okay. 4000, the possible outcome is 20%, 6000, 30%, like that. Similarly, year 2, year 3, we are given. For all the 3 different years, we are given the different possible outcomes. Calculate the expected net cash flows that we have already seen just now, expected net cash flows. Also calculate the NPV of the project using the expected cash flow using 10% discount rate and initial investment is 10,000. Very easy and very simple question. This is just to understand the expected net cash flow formula. Okay. Calculation of expected net cash flow. So year 1, year 2, and year 3, right? So year 1, what cash flows do we have? I'm just noting it down from the question. Cash flow is 2000, 4000, 6000, and 8000. What is the probability? 0.10, 0.20, 0.30, and 0.40. What is the expected cash flow? Expected cash flow is what? Cash flow multiplied by the probability, which is 200, 800, 1800, and 3200. And we will take a summation of this. The summation of this comes out as 6,000. Simple. Now, year 2, simply, I think the cash flows are same, right? The different possibilities of cash flows are same. So I will just note down the probability and expected cash flows. So the probability here is 0.20, 0.30, 0.40, 0.10, and we will just simply multiply it with the original values and arrive at the expected cash flows for the year 2 as well. Similarly, year 3, we have different probabilities. So I'm noting down the probabilities. So 30%, 40%, 20%, 10%. Expected cash flows comes as 600, 1600, 1200, and 800. So the total here comes out to be 4200. So these are the expected cash flows of different years. And can we calculate the present value of cash flows? Yes, we can easily calculate. So it will be 6,000 is for the first year, right? Divided by 1 plus 10% raised to the power 1. 4,800 is for the second year. 1 plus 10% raised to the power 2. Plus 4,200 is for the third year. 1 plus 10% raised to the power 3 minus 10,000 is the initial investment. Correct? 10,000 is the initial investment and 10% is the discounting rate. And hence, can we say that the expected NPV is equal to 2573? Simple. So in your earlier capital budgeting questions, you would have not given anything on probability. You would be simply given that year one, this is the cash flow. Year two, this is the cash flow. Year three, this is the cash flow. Now, since we're talking about risk, that means there is some estimation involved in terms of the cash flow as well as the probability. Hence, we have to make use of that and arrive at what is the expected net cash flow. Using that, we will arrive at the expected NPV. I hope, students, this is clear. Gajjar is asking, why not A, higher the risk, higher the return? So, Gajjar, higher the risk, higher the return is basically in project B, but we will not go directly by this principle because there is a element of for 1 rupee of cash flow, how much risk you are undertaking. Correct? That is how the right comparison method is. Using that, project B is coming out to be more fruitful. Thanks, Gajjar, for the answer. Okay. Right, students. So this is question number 1. Expected NPV is this much. Now let's go to the question number 2. Calculate the coefficient of variation based on the following information. Okay, now coefficient of variation or coefficient of variance is same. Which is what? SD divided by mean. We have been given 2 projects. Project A and project B. Simple. For both of them, we have to calculate that what is the coefficient of variation for both the different projects. Now, for that, students, first of all, you see what is given in the question. We have, see students, I have been using the term possible, right? So the same thing is given in the question, possible event. So there are 5 possibilities with different probabilities and here also different probabilities. So first of all, we have to calculate the mean and standard deviation separately, and then only we will be able to go to the coefficient of variation. So question number 2, calculation of expected cash flow. This is our step 1. We need to calculate the expected cash flow, right? Because we have been given the different possible cash flows. So the event, let me list down here, A, B, C, D, and E. There are 5 events. Net cash flow is also given for the different projects. 10,000, 12,000, 14,000, 16,000, and 18,000. Correct? And the probabilities also we can note down: 0.10, 0.20, 0.40, again 0.20, and 0.10. I'm just noting down the contents that are given in the question, right? Okay, students. Then expected cash flow is how much? Expected cash flow is how much? 1,000. 12,000 into 20% is 2,400. Then 5,600, 3,200, and 1,800. So the total here, the summation is how much? 14,000. Then comes the project B. I should mention here as project A, right? Project A, project B. Project B again, what is the net cash flow, probability, and expected net cash flow, right? These three things we'll have to put. So 26,000, 22,000, 18,000, 14,000, and 10,000. This is 10%, 15%, 50%, 15%, and 10%. So this comes as 2,600, 3,300, 9,000, 2,100, and 1,000. The total is 18,000. So the project B, the expected cash flow is 18,000, and project A, the expected cash flow is 14,000. Mancha, can you please elaborate what do you mean by PPP? I am not well versed with this PPP. Can you please help me with what are you trying to ask? Now, this is the expected cash flow that we have calculated. Now, the next step is calculation of standard deviation. Okay, for both project A and project B. This is very simple. Now, I'm putting the different events A, B, C, D, and E. Okay, students. Now, see, first time we are calculating it through the question. Now, students, see, what is the observation value? What is the possible event value? 10,000. What is the expected value? 14,000. What is the deviation? Minus 4,000. But we will take a square of it because of the reasons that I already explained. Correct. So what we have to do is we have to calculate the deviation. 10,000 minus 14,000 raised to the power 2 and multiply it with the probability 0.10. Similarly, here it will be 12,000 minus 14,000 raised to the power 2 multiplied by the probability of 0.20. Public-private partnership projects. Okay, we can apply anywhere, Mancha. If there is a question, if there is a practical applicability of this risk analysis, there are a lot of things that in which this area can be applied. Correct. Let's say in portfolio management, in any sort of a project evaluation, because we would need that what is the range between which the cash flows can vary, right? We cannot blindly say that, okay, the cash flows is going to be 10,000. We cannot say that, right? So it can be applied in any projects because the basic concept is that is there is a risk, right, in each and everything. Now, similarly, this will be this will be 14,000 minus 14,000 raised to the power 2, right? Multiplied by whatever is the probability, but this will be 0. I'm just now putting the values here, right? I hope the calculation part is clear. So this will be 16 lakhs. This is the value. This will be 8 lakhs. This is 0 already. Then 8 lakhs again. Then 16 lakhs. Similarly, here I'm just putting the first value here. So what is the first value? 26,000 minus 18,000. Raised to the power 2 multiplied by 0.10, right? 64 lakhs. Nil. 24 lakhs. This becomes 1 crore 76 lakhs. And the total of this is 48 lakhs. Okay. For the ease, students, I've already done the calculation and kept it so that we don't waste time in doing the calculation at least, right? Hence, this is first of all the variance. Hence, the standard deviation is equal to under root of 48 lakhs, and here it will be 176. This will be 2190.89, and this is 4159.23. Okay, Jamil is saying not able to get the calculation. Okay, I will explain again. See, what we are doing here is, for calculating the standard deviation, what we do is we take this individual observations, right, and subtract it from their respective means. Simple, 14,000 and 18,000. So how we have done here is 26,000 minus 18,000 is what I have taken, and multiply with their probability, taking a square here. After we have taken a square here. Similarly, here also for the second observation of B, what is the value? 22,000, right? So 22,000 minus 18,000 square multiplied by what is the probability? 15%, 0.15. Now on calculator, if you do 22,000 minus 18,000, which is 4,000, and take a square of this, which is 1 crore 60 lakhs, right, into 0.15, which is 24 lakhs, is what I have mentioned here. Okay, Jamil. Similarly, the next and the further will happen like that. Finally, the coefficient of variation is equal to 2190.89 divided by 14,000, 4159.23 divided by 18,000. So this becomes 0.1565, and this becomes 0.2331. Okay, Jamil, thank you. Yes, Mancha, you are right. Standard deviation is plus minus 2190. Okay. So if you see, students, the project A is better. Why? Because the coefficient of variation, let me put this number here, 0.2331. So this is better, right? Because for 1 rupee of mean, we are spending the lesser risk, or let's say we are undertaking a lesser risk. I will give time for all of you to note this down. Okay, students. Very good. Project A is less risky. Very good, Gajar. Your answer is right. 15.65 and 23.31. Perfect. Okay, students. So let us go to the next question. Question number 3rd. So question number 3rd says, now it is a already appeared question in November 2020. A Limited is considering 2 mutually exclusive projects S and Y. You have been given the below net cash flow probability distribution of each project. Okay, what is the net cash flow probability distribution? Project X and project Y. There are 3 different types of cash flows with their probabilities. That's okay. Compute the following. Expected net cash flow of each project. Right, Vasu, you're right. 4159. Perfect. I think all of you are getting the right answers, right? Okay, so compute the following expected net cash flow of each project, which is a very cakewalk for us, right? We can easily calculate. We have to just multiply and take a total. That's all. Multiply, take a total. Simple. Expected net cash flow can be calculated. Variance. Now, see, students, variance also we can calculate, right? Once the expected net cash flow is there, which is nothing but the mean, we will take the individual observation, take calculate the deviation, take the square and multiply with the probability, and then take the summation. Simple. Standard deviation under root of variance, coefficient of variation. Simple. This just now, like the same thing we just now did in question number 2. We calculated first of all this, then variance, then SD, then this. Okay, so I would request all of you to please do attempt this question, right? And there is nothing critical in this, that everything is covered in the earlier part of the session. Okay, so we'll move forward. So Shraddha is asking, calculation of standard deviation had never been this easy for me since my school times. Okay, Shraddha, thank you. Yeah. So, okay. Now let us go to the next part. So third question I'm leaving students for all of you to practice. Third question is very similar to the second question. All the steps are very much same. Okay. Now let us come to our business, right? Our business as professionals, because till now whatever we have studied is a very basic thing. Now we are coming now to the techniques of doing the risk analysis and capital budgeting, right? Now, whatever you have studied till now, those are the basic things like probability, variation, variance, standard deviation, coefficient of variation, all those things, right? Yeah. So there is a technique called, to evaluate the risk analysis in capital budgeting, there is the term called as risk adjusted discount rate. Now, students, this is very, very interesting. The next two topics that I'm going to cover is very, very interesting. Correct. I want all of you to please pay attention and listen to this very carefully. Okay. Now, again, I'm starting from the very basic. I'm not going to this term at all. I'm just picking this discount rate from this term. We'll go to the risk adjusted later. What is a discount rate? Very good, Jyot Kumar. Question number 3, he is saying it's 61,000. Maybe it's the expected net cash flow. Okay, you guys can attempt that later on. Okay, now please focus here. Now, discount rate is what actually? It is interest rate, right? Because in all your capital budgeting till now, you would have taken one discounting rate, which is essentially nothing but the interest rate. This is used to take the present value to future value, or from future value to present value, right? This is how we do, right, students? Now, why there is a need of interest rate? Why there is an interest in the economy? Now, I open this question to all of you. Let us see what is the thought process, right, from all of you. Why there is a need for interest rate? Thanks, Charu. Vasu is saying, sir, we should choose which project with project lower coefficient. Yes, Vasu, we should project the project. We should choose the project with the lower coefficient of variation. Correct. Now, my question to all of you is, now let us expect some of the very interesting answers, because all of you are participating really well. Why there is a need of interest in any economy? I'm saying, forget the topic that you are studying. I'm saying why there is an interest rate need. Why there is an interest need in any economy? I'm asking a very generic question. Please post any thought you have. Great. Oh, wow. We have a lot of answers. Very good. Charu is saying because of time value of money. That's right. Just a second. Something happened to my question handle. Yeah. Yeah. Hina is saying time value of money. Gajar is saying For estimate time value of money, perfect. Jamil is saying to maintain the gap between the inflation cash flow in the economy. Very good. I will come to this, Gajar. Jamil, I will come to this, Jamil. Okay. Vivek is saying value of money, right, Mancha? Because we follow time value of money. Whole FM is dependent on this concept. Very good. Abhijit is saying to compensate inflation. Very good. Vivek is saying value of money. Perfect. Great, students. Now, I'll tell you. Can I bucket all the reasons of interest into two parts? Okay. Now, then you imagine and tell me what is left. The first and the foremost reason, which all of you are very correct and very rightly said, is time value of money. Because money has a time value, right? For example, now how we used to study this, right? In our earlier part, let's say you have 100 rupees. 100 rupees, you are able to purchase a one standard basket of goods. Now the same standard basket of goods after 1 year will be 110. Correct? So the same basket, this is after 1 year. So hence we can say that there is an inflation / there is a time value. There is a general inflation, we can say. Right? Very good. Jyot is saying risk and inflation. Very good, Jyot. Now, since there is a time value of money, there is an inflation, whichever way we can say, right? The time value of money, there is inflation / inflation. So the first reason for this interest rate payment is this. Now, the second reason, which Jyot has just now mentioned, is risk. Risk of what? Risk of non-payment. Risk of not paying interest or principal on time, or risk of default, whatever you can say, right? Generally, this risk is monitored by the credit rating agencies. See, students, if today I want to go and take a loan, right? Bank, what it will do? It will say that, okay, for example, I'm going to take a housing loan today. So for the interest rate, bank will put two things. One, it will say that, okay, there is a general inflation or there is a general time value of money at the rate of 6%. But I see that there is a risk of non-payment also, right? Because your credit rating is not that good. So I will add another 2% of that. Hence, I will charge 8% from you. That's how the interest rate is derived, right? Now, consider two situations. Company A, company B. Now, company A is a very well-established company. It is being there for last 120 years, right? 120 years. So the fundamentals are really strong. The fundamentals, when I talk about fundamentals, let's say the financials are very strong. They have a very healthy balance sheet. They have a very healthy cash flows. Their profitability is very good, right? And there is a company B, which is just now 2 years, it's incorporated and it's just a startup. It is just a startup and it is burning cash like anything. There is no returns. The P&L is gone for a toss. Only the financials are not that good. But yes, in future, it is expected to grow like anything. Like in this, the growth is expected 4x, 5x. In this, the growth is expected only 10%, 20%, but still the fundamentals are strong here. Now, if both of them approach a bank to take a loan, bank will get, see, for both of them, when the bank will say that, okay, what is the interest rate? Bank will say that, okay, the time value is constant for both of them, right? Whether company A takes or whether company B takes, time value is same. So that is, let's say, 6%. But so I am putting here 6 and 6. But the bank will say that the risk of non-payment is higher in company B because this company has just now started. The P&L is not very strong. There are not enough cash flows that the interest obligations and the principal obligations will be met. So bank has already evaluated that company B is running. If I give a loan to company B, there will be a higher risk. So what bank will do? Bank will add a spread. In this case, let's say it will be only 2% for company A, but for company B, bank will add another spread of 1% for the higher risk. And hence, company A will get a loan at 8%, company B will get a loan at 9%. Now, the concept which I'm trying to explain here is higher the risk, higher the discount rate, or higher the interest rate. I hope you are able to understand what is the risk adjusted discount rate now. Higher risk will mean that higher interest rate. And higher interest rate means higher discount rate. Now you would have studied, students, that there is a term called risk-free rate. Risk-free rate, if it gets added to the risk premium, we call it as a total discount rate. Simple. Now, risk-free rate is, for example, 7%, in which there is no risk at all, only time value of money. Simple. Only general inflation, that's all. But there is a risk premium of, let's say, 2%, and hence the 9% is the overall discount rate. Now, RADR means RADR, which is the risk adjusted discount rate, means that using the discount rate which is adjusted for the risk. Don't use risk-free rate. Use the risk adjusted discount rate. That means use this 9% while you do the NPV. Simple. That is called as discount rate. So in under RADR, discount cash flows using risk adjusted discount rate. Don't use the simple risk-free rate to discount the cash flows. Use the risk adjusted discount rate to discount the cash flows. I hope this concept is clear, but there is a problem with this. Now, what is the problem? The problem is, if we say that there is a 7 plus 2, 2% is the risk premium, we are making an inherent assumption that every year the risk will be 2%. The risk premium will be 2%. So the limitation is that every year will get discounted by 9%, right? So we are making an inherent assumption that every year the risk will be 2%. Okay, students, to overcome this limitation, there is a second technique called certainty equivalent. Sorry. Now, please understand carefully. So RADR is the first technique, right? RADR we completed now. RADR is simply you add the risk premium in the risk-free rate, and then you do the discounting to calculate the NPV. Simple. Now, what is the certainty equivalent approach? Now, understand these two situations. Situation 1, situation 2. The situation 1 says that there is a cash flow of 2 lakh rupees. Okay. Situation 2 says that there is a cash flow of 1,50,000 rupees. But situation 2 says that this cash flow of 1,50,000 is guaranteed. It is 100% certain. It is 100% certain. I'm again going back to the initial part of the session where I said that there is a certainty, there is a risk, there is an uncertainty, right? So we are talking that situation 2 of cash flow of 1,50,000 is 100% certain. There is a 100% certainty that 1,50,000 is going to come as a cash flow. How this is possible? Because there is a legal agreement, correct? There is a legal agreement with the customer. The customer will have to purchase this much of quantities, right? So there is a 100% certainty. Now, the second situation, this 2 lakh rupees I'm taking as an estimated cash flow, but it is a risky proposition. It is a risky cash flow because I am not sure whether this is going to happen or not. Simple. So can I say that this 2 lakh rupees, can I break it into two parts? So situation 1 is also taken from situation 2 only. In that case, can I say that 2 lakh out in this 2 lakh rupees, there are two parts. 1,50,000, which is the guaranteed cash flow, right? And 50,000, which is the risky premium. Okay, students. So 1,50,000 is basically the guaranteed cash flow, which will happen in any case. But 50,000 is the risky premium, and hence there is a total. If you want to undertake a risky proposition, let's take an estimate of 2 lakh. If we want to take a 100% guaranteed proposition, let's take 1,50,000. Correct. But I've broken it down here. So we say that the risky. Now we say that there is a risky cash flow of 2 lakh, but there is a certainty. There is a certainty. Certainty means 100% sure. There is a certainty equivalent amount of 1,50,000, right? I hope you're able to get me. There is a certainty equivalent amount of this 2 lakh is equal to 1,50,000, correct? So we say that there is a term called CE coefficient. What is called as CE coefficient? CE coefficient is 1,50,000 divided by 2 lakh. Correct? This is the guaranteed cash flow and this is the total cash flow. 2 lakh is the total cash flow. Total cash flow means the risky cash flow, I'm saying. This into 100, it becomes a 75%. So 75% is the certainty equivalent coefficient. Now, if we are given that the risky cash flow is 4 lakh, we will just multiply it by 75% and we will come to know that, okay, 3 lakh rupees. 3 lakh rupees is the 100% certain amount that is going to come as a cash flow. Simple. And hence, on this amount, we can do the discounting part, correct? We can do the discounting part and do the analysis in terms of the capital budgeting. So in this, what we have done, we have eliminated the risk, right? We have eliminated the risk of 1 lakh rupees. That is out of the analysis. And hence, now we are better equipped to take decision because we have taken risk out of the capital budgeting decision. Okay, students. Now, with this, let us break for 10 minutes and we will reconvene at 7:25. Welcome back, students. So there is one question from Memen. How to get 4 lakh? Okay, no, 4 lakh. I just assumed it can be, let's say, in our example, it was 2 lakh, right? Or it can be, I'm saying 3 lakh, but we will multiply it by 75% to arrive at the guaranteed cash flows, the 100% certain cash flows. Correct? It can be anything, but I've just tried to use this 75%. I mean, try to calculate this 75% using the numbers as per the example. Okay. Now, for a better clarity, let's do this question number 4. Question number 4 says, Gaurav Limited is using certainty equivalent approach in the evaluation of risky proposals. The following information regarding a new project is as follows. They have given us the different years. The negative is actually the cash outflow. The positives are actually the cash inflows. And there are the certainty equivalent quotient. A certainty equivalent quotient says that, so 320 is the total cash flows, but the guaranteed cash flow out of that 320 is 320 multiplied by 80%. Simple, right? Hence the riskless rate of interest. Now students see the riskless rate of interest in the government securities is 6%. Determine whether the project should be accepted. Very easy, very simple. Now, since the question has already said that we have to use the certainty equivalent approach, right? Can we solve it using that? Question number 4. So here 0, 1, 2, 3, 4, and 5. Then already we have been given expected cash flows negative 4 lakh. I'm just putting the total cash flow, which is the risky cash flows, right? Hence, we are using the term expected cash flows here. 4 lakh, 320, 280, 260, 240, and 160. Then the CE coefficient, the certainty equivalent coefficient is also given, which is 1, 0.80, 0.70, 0.60, 0.40, and 0.30. Now, as you see that time increases, as they go into the 5th year, the certainty equivalent quotient comes down. That means higher the time frame, higher the risk, right? Because you might not go bankrupt in overnight, but you might go bankrupt in 5 years, right? There is a higher chance of going bankrupt in 5 years compared to the lesser chance of going bankrupt in just overnight, or let's say 1 year, 2 years, right? So hence CE coefficient is higher. So the CE cash flows, certainty equivalent cash flows is how much? We'll just multiply these two numbers. So if it is 1, 2, so here this is 1 multiplied by 2, simple. So it is 4 lakh, 2,56,000, 1,96,000, 1,56,000, 96,000, 48,000, right? These are the cash flows. Then present value at the rate of 6%. The discounting rate is given at the rate of 6%. Yes, Charu, very good observation. Now see, I'm really happy since all of you are contributing through these thought processes. Now Charu is saying expected is mentioned because we are not given the probability and it is already adjusted for the probability. Yes, hence they have mentioned expected. Very good. So because if the probabilities are given, they would have given us the complete cash flows, not the expected cash flows. Since the question is already talking about expected cash flows, that means it is already adjusted for the probabilities. Okay. The present value. Okay, Jamil, I will come to that. What does the CE actually tells us about? I will come to that question. So present value is 1 for the 6% I'm saying, then 0.943, 0.890. In this question, actually, there is one more thing which I have skipped currently explaining you, right? If somebody gets the question around that, please do post the question. There should be one question in all of your mind while you would have read this. I will clear the doubt after this question. Okay. 0.747. So the net present value of CE cash flows is what? 4 lakh, 241, 408, 174, 440, 131, 040, 76, 032, 35, 856. So the total net present value is how much? 258, 7, 258, 776. Now, this is the solution that was asked. Rohan is saying we have to add the risk premium. Okay. Vasu is saying, sir, what will be the criteria for accepting or rejecting the project? See, Rohan, we will come to that discussion after this. As I told, now Vasu is asking, sir, what will be the criteria for accepting or rejecting the proposal? The criteria remains same. Now, in capital budgeting, how do you use to assess? If NPV is positive, you will accept the proposal. If NPV is negative, you will reject the proposal. Simple. If there are two projects to be compared, then you will compare the NPV of both the projects, or you will compare the IRR of both the projects. Correct. So whatever approach you adopted in capital budgeting, the same approach you will adopt here. Okay, Vasu. So hence that is the criteria for accepting or rejecting the proposal. Memen is saying how to get 6% amount. Okay, Memen, I think you are asking about these values, 6%. See, because I've just used the 6% that is given in the question, and I've taken the present value of this. Okay, Rakesh is also asking from where it comes. So, okay, let me mention here 1, 2, 3, 0, 1, 2, 3, 4, 5. So, if we do 1 divided by 1 plus 6% raised to the power 0 is equal to 1. 0 I put because you're talking about the 0 year, right? Here it will be 1 divided by 1 plus 6% raised to the power 1, which is equal to 0.943. Then for the second year, it will be 1 divided by 1 plus 6% raised to the power 2. I'm just calculating the present value factor, right? Present value factor, you will calculate it like this only, you know? 0.890. Third year, it will be 1 divided by 1 plus 6% raised to the power 3, which is equal to 0.840. Then fourth year, it will be 1 divided by 1 plus 6% raised to the power 4, which is 0.792. And similarly, for fifth year, 1 divided by 1 plus 6% raised to the power 5, which is equal to 0.747. I hope Rakesh and Memen, both of your query is clear with this. Okay, this is, even don't get confused with this, what I've put here. The zero factor, the 0 period factor is always 1. You can always take it as 1. but I have just explained it. If you do it like this also, anything raised to the power is 0 is 1. So 1 by 1 is also equal to 1. Okay. Now, okay, now Gajar is asking, sir, how we conclude whether project is accepted or not in this question. The project should be accepted. NPV is positive. NPV is positive. Hence, we should accept the project. Simple. If NPV is positive, that means there is some return that is getting generated over and above the riskless return. Riskless return of 6%, right? Now, let me come back to our business as professionals, right? Now, students, we have studied two things, RADR, certainty equivalent. What we do in RADR, we adjust the interest. We increase the interest. In certainty equivalent approach, we reduce the cash flows. We reduce the cash flows to make it equivalent to the certain amount, the guaranteed amount, right? And interest is increased to account for the higher risk that we are taking. If you increase the interest, it will reduce the present value, right? Higher the interest, lesser the present value. Lower the interest, higher the present value. I'm saying if you convert the future value to the present value, right? I think this all of you will agree. And similarly, lesser the cash flow will also reduce the present value. So both the approaches have the impact of reducing the present value. One more thing that we studied, that in this there is a risk premium. In this there is a risk premium, and in this there are different risk adjustment factors, which is the certainty equivalent coefficient, right? Different risk adjustment factor. Now, I am giving you 4 things. Okay, again, I am opening the floor for one question. Okay, I'm now coming to the main point. Let's say again, we are talking about a project A. Project A, in terms of cash flows, you are given data in these two things, right? I'm just giving you the combination of data. So you are given the risky cash flow, and also you are given the guaranteed cash flows. Okay, please hear my question first, then try to attempt and think it. So in terms of cash flows, we have been given the risky cash flows as well as the guaranteed cash flows. And in terms of the interest rate, okay, interest rate, we have been given the risk free rate and risk adjusted rate. Now, please understand, students, I am putting one very important thought. Yes, Charu, wait, I am telling that only. The Charu saying 6%, you're trying to tell something. I will go back again to the question number 4 and tally this thing with that. I'm actually on that point only as of now. So hence, all of you, please listen to my question very carefully. You all only will give the answers, right? So I'm saying, for there is a project A, you have been given these 4 data sets. One, you have been given the risky cash flows. I'm putting it as 1. Second, you have been given the guaranteed cash flows. Third, you are also given the risk-free rate. Fourth, you are also given that risk-free rate plus risk premium, which is the risk-adjusted discount rate. You tell me whether you will use what combination of cash flows and interest rate to discount. Whether is it okay to use 1 plus 3, whether it is okay to use 1 plus 4, whether it is okay to use 2 plus 3, or whether it is okay to use 2 plus 4. Because what is your capital budgeting? Capital budgeting is using the cash flows and the interest rates as inputs, right? So I'm saying, while selecting, how will you select? Let's say, again, I'm saying 1 plus 3 you will do. 1 is what? Risky cash flows. And 3 is what? Risk-free rate. So you will take the risk-free rate and risky cash flows and do the capital budgeting. That is option number A. Option number B I'm giving to all of you is whether you will take the risky cash flows and you will take the risk-adjusted rate. Option number C is whether you will take the guaranteed rate and the risk-free rate. And option number 4, which is D, I'm putting. Option number D, I'm putting whether you will take the guaranteed cash flows and risk-adjusted rate. Now let us see the answers. Abhijit is saying 1 plus 4. 1 plus 4, okay. Rohan is saying 1, 4, 2, 3. Rohan, you will take everything. Okay, you all of you students, please tell me option A, B, C, or D. You just tell me like this, right? Don't go into 1 plus 2, 1 plus 4, 1 plus thing. Whether you will adopt option A, in which you are taking the risky cash flows and the risk adjusted rate. Vasu is saying 1 and 3. 1 and 3. Okay, great. Tanu is saying 2 and 3. Okay. Rakesh is saying 2 plus 4. Okay. Memen is saying D. Perfect. Saurav is saying 1, 4, 2, 3. Again, same thing, Saurav. Use okay, you are saying 1, 4, and 2, 3. Okay. Hina is saying B and C. Wow. Very good. Now, can I explain? I think all of you have attempted in your own way, and most of you are correct. But what gives me confidence is at least your thought process is correct. That is more important. So, students, please see now. The right answer is let me mark it with some other pen. B and C. Mansha is saying B. Shraddha is saying 2 and 3. Charu is saying A and C, and Gajar is saying B. Okay, now come back, students, here. This is the right approach to take. I'll explain how. So students, as I explained you, what is the difference in these two? If I take only the CE, certainty equivalent. Now certainty equivalent, what you are doing is you have already reduced the cash flows, right? You've already reduced the cash flows. Now on top of it, if you're going to take the risk adjusted discount rate, that means you are going to increase the interest rate. Then don't you think you're adjusting for the risk twice? You're getting my point. If you have already taken the lesser cash flows in certainty equivalent approach, and again you're taking the higher interest rate, which is the risk adjusted discount rate, risk is getting adjusted twice. To avoid this, we say that in certainty equivalent approach, always use riskless interest percentage, and hence In question number 4, Charu, we have used 6%. And the question came from Rohan as well. Okay, students, I hope it is clear. So wherever you have already adjusted cash flows for the risk, for the lesser amount, you should take a riskless interest, right? However, in RADR approach, risk adjusted discount rate approach, okay, Charu, no issues. Okay, no issues. Yes, that's right. Understanding should be right. So RADR, what I was saying is RADR is, since in RADR, you are increasing the interest already, right? And if you use the guaranteed cash flows, which are generally lesser in amount, right? Again, you will end up adjusting risk twice. Risk adjustment will happen twice, right? Which is not right. So if you have already taken a higher interest, right? If the interest is already higher, then we should take the risky cash flows only. Okay. So hence, either we should adopt either B combination or C combination. Mansha is saying business environment is full of uncertainty. That's why I recommend the organization to go with the risk adjusted rate. No, but Mansha, okay, now I will, to prove this, now I will take one more example. Okay, students, I will exactly come to your point, Mansha. What I'm trying to say, whether you use CE equivalent approach or RADR approach, you will get the same answer. I'm going to prove it now. And Mansha, I think that will solve your query as well. I hope this point is clear till now, right? If we are using the risky cash flows, we have to use the risk adjusted discount rate. Simple. If we are using the guaranteed cash flow, we have to use the riskless discount rate. Simple. Now, students, please hear me again very carefully. Yeah. Now, I'm taking one example. We are today sitting in 0 year, right? After 1 year, something is going to happen. What is going to happen is, after 1 year, the cash flow expected is 1,20,000. Simple. Risk-free rate is actually 4%, and this is a risky cash flow, not a guaranteed cash flow. Okay. So this is not risk-adjusted cash flow. I mean, this is not certainty equivalent. This can happen or this cannot happen. There is a risk. There is a risk that 1,20,000 will be the cash flow after 1 year. It's not certainly guaranteed cash flow. Okay. Then there is a risk premium of 8%. Can you tell me what is RADR? Risk adjusted discount rate is 12%. Simple, right? 4% plus 8%. Simple. I hope this example is clear till now. Now, using the RADR approach. Now you are only given this information only, right? And you have to calculate the NPV or the present value at 0 year, that is today, using both the approaches, using RADR as well as using the certainty equivalent approach. Very good, Rohan. Very good, Abhijit. 12% is right on RADR. Okay, students. Now, RADR, what we will do is simple. 1,20,000 is the risky cash flow divided by 1 plus. Now, I have taken the risky cash flow and hence I will take the RADR rate, right? Because RADR is already increased from 4% to 12%, correct? So hence the risk is already accounted in RADR. Simple, right? So this comes as 1,20,000 divided by 1.12, which is equivalent to 107 142.80. This is the NPV. Simple. Using the RADR, our NPV, or let's say the present value of the cash flow, comes at 1,07,142.80 rupees. Now, using certainty equivalent approach, first of all, we need to know that what is the CE coefficient. This is what we will have to calculate first. How we can calculate? So students, if you see 1,20,000 is the risky cash flow after 1 year, what is the present value of that? Right? Divided by 1.12. This is the present value. If this would have grown basis the risk-free rate of 4%, then after 1 year, the value of the guaranteed cash flow would be 111,428.57. Simple. 1,11,428.57 is the guaranteed cash flow. Perfect, Vasu. Your answer is right. So hence, this is the guaranteed cash flow. So what we have done here is we have divided the risky cash flow with the risk adjusted discount rate and multiplied with the risk-free rate of return to arrive at the guaranteed cash flow. Now, can we calculate the CE coefficient? Yes. 111,428.57 divided by 1,20,000. Guaranteed cash flow divided by the risky cash flow, right? So this will give us 0.9285. Simple. So the certainty equivalent cash flow is actually 1,20,000 multiplied by the CE coefficient of 0.9285 divided by, now this we are going to divide by 1.12 or 1.04 or 1.08. Now please students, don't disappoint me. Please post the right answer. For calculating the certainty equivalent NPV under the certainty equivalent approach, we have already done the numerator adjusted for the certainty amount, right? 1,20,000 is the risky one and this. But what denominator we should take? 1.12 or 1.04 or 1.08? This I am expecting a response from all of you now. Already numerator you have adjusted. Very good, Rohan. 1.04, right? Already numerator you have adjusted for risk. The denominator you should also take the riskless one. So this is coming from the option C here, right? The guaranteed cash flows and the risk-free rate. The combination of second and third is what we are going to take there. Right. So 1,20,000 multiplied by 0.9285 divided by 1.04. This will be equal to the same NPV 107,142.85 NPV. Abhijit, please correct it. It's not 1.08, it should be 1.04. Charu, you're right. Shraddha, you're right. Ms. Vajjar, you are also right. 92.85%, which is the certainty equivalent. Very good, students. Let us move forward. So hence now, okay, sorry, there was this question. Mansha has said that business environment, hence I recommended to go with RADR. What we recommend is Whether you go with RADR or whether you go with CE, certainty equivalent cash flow, the result is same. But please be watchful. If you are using RADR, you have to take the numerator also including risk. If you're taking the certainty equivalent approach, the denominator should be the risk-free rate of return. Okay. You're right, Charu. You're right, Khushi. 1.04, 1.04. That's perfect. Okay, students. Now let us go to the questions. Question number 5. Okay. Vrinda said why 1.04. Okay, Vrinda, let me go again. Just a second, students. Let's go back again once. See, Vrinda, what we are doing in certainty equivalent approach. Okay, let me go to that screen only. That slide where I explained the difference. Yes, here. So, Vrinda, hear me again carefully. In certainty equivalent approach, already we are reducing the cash flows, right? We are reducing the cash flows. We are making the risky cash flows as the guaranteed cash flows. Now, if you end up taking the risk adjusted discount rate, that means you are using a higher interest rate. That means risk is getting adjusted twice, once in the cash flows and once in the discount rate also. So that means there is twice the risk getting adjusted, which is not the right case, right? If you are using the riskless cash flows, you should also use the riskless interest percentage. Hence, we are using 1.04. Okay, Rinda? Thanks, Mancha. Let us go to question number 5. Question number 5 says, a project requires an initial outlay of 3 lakh rupees. That's fine. The company uses certainty equivalent method approach to evaluate the project. They have already given you that certainty equivalent approach they will use. Now, all of our mind and the brain should say that if we are using certainty equivalent approach, we are least bothered with the risk adjusted rate. We have to see that risk-free rate should be the main point of usage. Let's read the question. The risk-free rate, very good. If you see, the question also has given you the risk-free rate, which is the need in the question, which is 7%. Following information is given, year-wise data is given, cash flows, certainty equivalent, and present value factor is also given. This is a question that had came in January 2021, and this is very similar to the earlier question that we have just solved now. So this also I'm giving all of you for the homework. Okay, please do attempt this. So I'm just discussing this question. What we have to do is, since the company is following the certainty equivalent approach, both these columns have to be multiplied. And then after multiplication, the sum has to be, no, sorry, not the sum. After multiplication, we have to apply the present value factor, right? Calculate the present value and calculate the summation here. Simple. And minus 3 lakh from there. Yes, Vasu, question is easy. Now, everything will be easy if you go with the pure logics and proper thought process building. Don't try to remember, or what I can say, don't try to always try to understand the logic behind the formula as far as possible, right? Saurabh, I need to check whether the handwritten notes can be uploaded or not. That I will check and come back, okay? So this I'm leaving then, this question. Now let's go to the question number 6. Question number 6, students. Now please pay attention. Following information have been retrieved. Yes, Gajar, it's same as we done. So I'm leaving the question number 5 as of now. Question number 6. Following information have been retrieved from the finance department of Corp Finance Limited relating the projects of X, Y, and Z. Perfect. So there are 3 projects that are currently being evaluated. So the net cash outlays is given What is the cash outflow? Project life is also given 5 years. Annual cash flow is also given 14 lakh, 8 lakh 40 and 6 lakh. This is the annual cash inflow for the 5 years annually that is going to come. And most importantly, coefficient of variation is given. Now, all of you know what is coefficient of variation. Simple, standard deviation divided by the mean. You're required to determine the risk adjusted net present value of the projects. Now it is indicating that we have to calculate the risk adjusted net present value of the project considering the company selects the risk adjusted discounted. It is very clear. It is a question on RADR, right? On the basis of the following coefficient of variation. Now, please don't get confused here. Coefficient of variation is only used to see that what is the right RADR for that company. Let me go to the solution here. Calculation of risk adjusted net present value. Okay. What are the different projects? Projects X, Y, and Z. Cash outflow is how much? Cash outflow is how much? 42 lakh, 24 lakh, and 20 lakhs. This is the cash outflow. Risk adjusted percentage is what we are going to find out now. Now, students, see, this is a very good question. The question is indicating that the risk adjusted discount rate is dependent on the coefficient of variation. See, is on the basis of coefficient of variation. What is the coefficient of variation? 2. If we find out in this table where does the 2 lies? 2 lies here. For a 2 coefficient of variation, the risk discount rate is 20%, and the present value factor, cumulative factor, is also given as 2.990. Similarly, the second project, I am taking a separate color, 0.8. 0.8 is 12%, and the factor is 3.604. The last coefficient variation is 1.6. 1.6, 16%, and it is 3.24, 3.274. Simple. Correct. So we already have the risk adjusted 20%, 12%, and 16%. Annual cash flows is how much? 14 lakh, 8 lakh 40,000, and 6 lakhs. Factor PV is how much? 2.990, 3.604, 3.274, right? This is the present value factor, right? And hence the discounted cash flows will be, so 14 lakh multiplied by 2.990, 14 lakh multiplied by 2.990, which is 41 lakh 86,000. I'm writing here, what I have done is 14 lakh multiplied by 2.990. Similarly, 8 lakh 40,000 multiplied by 3.604. Thirty lakh 27,360. And the last one is 6 lakh multiplied by 3.274. 1964 400. Six lakhs multiplied by 3.274. Okay, now we will calculate the NPVs. NPV X, Y, and Z. X, the income, the inflow is 41,86,000 minus outflow of 42 lakhs. So NPV is negative here for 14,000, right? For Y, it is 30,27,360, right? The cash inflows minus 24 lakhs. 627,360. The last one is 19,64,400. 20 lakhs. 35,600. So the NPV for X is negative, Y is positive, and Z is also negative. So hence the project Y should be selected because it has a positive NPV. But what is the question asking us ultimately? It is only asking us to determine the risk adjusted net present value of the project. So these are the risk adjusted net present value of project. Simple. Saurabh, okay. CE is the certainty equivalent. Saurabh is asking, could you please tell what is CE and why it is getting reduced? So Saurabh, please refer to my previous part of the session again. What is this is actually, this is the certainty equivalent amount. Certainty equivalent. So as I told you in the situation 1 and situation 2, while I introduced the certainty equivalent concept, right? Situation 1, there is a 2 lakh rupees of cash flow. Situation 2, there is a 1,50,000 rupees of cash flow. 1,50,000 is guaranteed, but 2 lakh is a risky cash flow. So to convert 2 lakh into 1,50,000, we need the CE coefficient, right? The certainty equivalent coefficient. And hence the risky cash flow is getting reduced to the certainty equivalent cash flows. Yeah, sorry. Okay, Saurabh. So please do refer the previous part again. You will be able to get it. Rohan, yeah, perfect. Please show upside working. Okay, this working you want. Yes, Gujar, right. Why should be accepted? Okay, students, let's go to the next part. Yeah. So next is question number 7. Okay, the question number 7 says that Textile Manufacturing Company Limited is considering one of two mutually exclusive proposals. Okay, there are two proposals, M and N. It is considering one, which requires cash outlays of 8,50,000 and 8,25,000 respectively. Wait, Abhijit is saying certainty equivalent means we remove the risky part before only. That's why we use the risk free. Yes, Abhijit, that's right. Understanding is right. Okay, Gio, thank you. Which requires a cash outlays of 8,50,000 and 8,25,000 respectively. The certainty equivalent approach is used in incorporating risk in capital budgeting decision. They are saying that you use CE method, certainty equivalent method. The current yield on government bonds is 6%. That means they're trying to say that it is 6% is the riskless, risk-free rate of return. Right, students? Charu. Okay. Charu, I missed your query. Just a second. Sir, in CE, why we multiplied with 4% because we're calculating the amount of 120, which is risk free. No, Charu, just a second. I think you are asking the question from the previous example, this one. So, see, Charu, what we did here is we multiplied by 1.04. See, first of all, we calculated what is the present value, right? Risky cash flows and risk adjusted discount rate. So what is the exact present value we can calculate, right? Now that if it is growing by only 4%, then what is the value? That will give us the guaranteed cash flow. Hence, we multiplied by 4%. Okay, Charu. Anyways, this example I have taken only for all of our understanding only, right? But if you see in the questions, certainty equivalent is always given. The coefficient is always given, right? We don't need to calculate it. But if we need to calculate it, question will give you all the relevant information to calculate it. Okay. So don't get worried on that part. Yes, Vasu, that's right. Risk-free rate. And this is used as a risk-free rate. The question is also specified in the second part. The expected net cash flows and their certainty equivalents are as follows. They are given the expected net cash flow certainty equivalent for both the projects M and N. Present value factors for one discounted at 6% is this. For 3 years they have given. Analyze which project should be accepted. So I'm just doing it in a rough manner. I'm just putting the numbers in a rough manner. Okay. See, 4,50,000 is the total cash flow. Certainty equivalent coefficient is this one. And the present value factor is 0.943. Thanks, Charu. Then year 2, 1, 2, 3. Okay, 5 lakh multiplied by 0.70 multiplied by 0.890, which is the second year factor. Similarly, third year factor is 5 lakh multiplied by 0.50 multiplied by 0.840. Simple. This, if we total it, it comes as 860, 980 less 850 of the initial investment, correct? So hence the net value comes as 10,980. NPV value is equal to 10,980. So the project M, this is for project M, correct? Similarly for project N, we can say that 4,50,000 is the first year, 0.90 is the first year certainty equivalent, 0.943, 450 again, 0.80 multiplied by 0.890, then 5 lakh multiplied by 0.70 multiplied by 0.840. So the total here comes as 996,315 less outlay. Initial outlay is how much? 8,25,000. That is also given in the question, right? So hence the NPV comes out 171,315. Which NPV is higher? 1098 or 1 lakh? Definitely this. Right. So project N will be selected. Now, students, why I picked this question is because the second part is very good. Now let us read the second part. If the risk adjusted discount rate method is used, if they are saying now think about RADR method, risk adjusted discount rate method. Identify which project would be appraised with a higher rate. That means which project we will use the higher rate of interest. Definitely the project in which there is a higher risk. How can we identify whether project M is having a higher risk or project N is having a higher risk? Now that I think all of us can definitely see from the table only. But still, I want all of you to please attempt this question, which I'm asking, is whether project M is less risky or project N is less risky. Which project is higher risky? Okay, let's put it like this. Yes, Vasu, you're right. Rohan, you're right. Project N should be selected. While we compare M and N should be selected. My question is whether project M is carrying a higher risk or whether project N is carrying a higher risk? Which project is carrying a higher risk? Then our answer is very simple. The project which is carrying a higher risk should be appraised with a higher rate, right? Instrument. So yes, Vasu. In second part, we won't use the CE rate. Second part is just a thought that they are asking, right? It's they're not asking us to calculate. They're just asking that which project higher rate would be used. M is high risky. Rohan is saying, Abhijit is saying M is high risky. Right. M is high risky. Why? Because the CE is lesser. The certainty equivalent coefficient is lesser compared to project N. Here it is 0.8, 0.9. That means there is a higher risk involved in project M, right? Very good. So CE coefficient, if it is lower, right? Higher the risk. Simple. Project M, Jamil is saying. Rakesh is saying where NPV is high, risk is low. No, 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 Rakesh. We have to see it in relation to the CE coefficient. Okay, Rakesh. Mansha is saying project M is risky. Very good. Tanu is saying project M is risky. Very good. Saurabh is saying project M is having a high risk. Very good. All of you are on the right thought process, students. Very good. The CE coefficient, the lower it is, the higher the risk is, right? Because if the CE coefficient is lower, that means the difference between the risky cash flows and the guaranteed cash flows is higher. That means the risk is also higher, right? The deviation will be higher. And what is the risk? Risk is just a standard deviation, right? And standard deviation means the deviation of the possible outcomes from the expected outcomes. That's all. Okay, students. Now let us go to the next part of the session. Now there are two more techniques to understand or to do the risk analysis in capital budgeting. First one is sensitivity analysis. Now, what is sensitivity analysis? So students, I think by now, all of you would know that capital budgeting is a model, right? This is a model. Model of what? In which there are some inputs, some processing happens through this model, and then there is an output. What is output? Output is very easy. We know it is NPV, right? Output is NPV. What are inputs? Inputs are cash outflows, cash inflows, rate of discount, or we can say discount rate, whatever it is, interest rate, whatever you can say. Then there is time period. What is the time period? Right? Similarly, this cash inflow is actually also dependent on certain factors, right? For example, understand a business. The business runs on certain costs, certain revenues, right? So what is the revenue? Minus cost. Ultimately, that is my cash inflow, right? Revenue also, what is the volume? What is the price? Volume multiplied by price will come as revenue, right, students? So all these things are inputs. All these inputs are given into a model called capital budgeting. That model will throw some result called as NPV, net present value. Now, we know that all these factors are constant, but what if we change one unit of these inputs, what impact it will create on the NPV? So what is sensitivity analysis? Sensitivity analysis is that if we change input by a certain amount, what impact it will have on output, keeping the other input same. Change in one input will lead to what change in overall output? Simple. Earlier, we have taken time period as 6 years. Now, if we are taking time period as 7 years, what impact will it have on the NPV? Earlier, we were taking the rate of discount as 8%. Now we are taking as 10%. What impact it will have on NPV? That is called as sensitivity analysis. Sensitivity, we are trying to find out how much sensitive are these inputs in relation to the outputs. We will understand this better through this question number 8. From the following details relating to a project, analyze the sensitivity of the project to changes in initial project cost, annual cash inflow, and cost of capital. They are saying that there are 3 inputs. One is the initial project cost, second one is the annual cash flow, and third one is the cost of capital. On these 3 inputs, you tell me what is the sensitivity of the project. That means what is the impact on the NPV if I'm going to change. Initial, they are saying generally it is 120, 45, 4, and 10%. But they're saying identify which of these 3 factors the project is most sensitive. Most sensitive will be if, let's say, wherever the NPV changes higher. Let's say if I change the initial project cost by 1 rupee, the NPV changes by 10. If I change the annual cash flow by, sorry, let me take it as 100 here. If I change the annual cash flow again by 100, the NPV changes by 12. So annual cash flow is more sensitive, right? For the same amount of change, it is leading to a higher impact in NPV. Okay, students. So we'll understand this better using this question. If the variable is adversely affected by 10%, so they are trying to say is that if the variable is adversely affected by 10%, then you try to calculate the sensitivity of project, sensitivity of this. So let us see, let us calculate the base case first of all. If nothing changes, everything we take as is, then we change the cash inflow in this scenario, then we change the project cost in this scenario, and finally we change the discount rate in this scenario. Okay, now how to do this? First of all, present value of annual cash flows. Base case, we will take the same number, 45,000 multiplied by 3.103, right? That is what it is given. No, this is for 11%. We have to take for 10%, which is 3.169. Project cost. Project cost is 1,20,000. This one, right? This is the initial project cost. I'm first of all taking the base case. Then what is the NPV? NPV is 22,605. This is the NPV. Now, what if I change the cash inflow by 10% and it is given that it is adversely affected? So how can we adversely affect the cash inflow? By reducing the cash inflow by 10%, right? So what we are going to do is 45,000 multiplied by 0.90, right? We have adversely affected the cash inflow and multiplying it by the 3.169. Let's keep rest other things as constant, as the same only. Project cost I have taken 120 only, hence the impact will be 8344. So see students, the NPV has changed from 22,605 to 8344.5 in percentage terms. Can we calculate like this? Just a second, students. I think there is something wrong with the screen display. Let me display it again. Give me a second. Technical team, this is okay, right? Okay, perfect. Yes, students. So let us continue. What I was saying is that the cash inflow, if we change it by 10%, if we reduce it by 10%, the amount comes as 8344.5, right? Can we find out that what is the percentage change in NPV from where it has gone to where? So 22,605 has gone down to 8344.5. If we divided it by the 22,605, can we calculate that what is the percentage here? The percentage drop in NPV is 63.08 percentage, right? Now, let us keep other things constant and let us adversely affect the project cost. So 45,000 multiplied by 3.169, but here 1,20,000 multiplied by 1.1, correct? We have to increase the project cost. Adversely affecting means the project cost has increased. So 120 has increased to 1,20,000 plus 10% on 1,20,000. So it is 10,605. Now I am putting it here. This is 22,605 minus 10,605 divided by 22,605. This as a percentage comes as 53.08 percentage. Simple. So Memen is asking, how do I get 90? So Memen, if you see, I can write it as 1 minus 10 percentage also, right? Because we have to reduce the variable by 10%. That is given in the question. Hence, I took 0.90. So to adversely affect the cash inflow, I have to reduce the cash inflow by 10%. Hence, I have multiplied it by 0.9. Okay, Memen? Discount percentage. Now, 45,000 multiplied by. Now, if I have to adversely affect the discount percentage, so ideally 10 percentage, I will have to increase by 1.1, correct? Because if I increase the discount percentage, the NPV will come down. Hence, it is a adversely affected. If I am reducing the discount percentage, it will increase the NPV. Hence, it is positively impacting, correct? So in this case, since we have to adversely impact, hence we will increase the discount rate. 10% into 1.1 becomes 11%. So discounting will happen basis the 11%. For that also the rate is given 3.103. Rest all things will be same, right? 45,000 is same. 1,20,000 is same. It becomes as 19,635. And I am writing it here only. This is 22,605 minus 19,635 divided by 22,605. As a percentage, it is 13.14%. So just to highlight the last part, this, and this. So with that 10% decrease in cash flow, NPV gets impacted the most. Hence, the most sensitive factor is change in cash flows, right? Because that is impacting the NPV most compared to the other two adverse impacts. Hence, the most sensitive factor is 63.08% is basically change in cash flows. We have to mention it like this: change in cash inflows. In bracket, we can mention 63.08. Yes, Rowan, you're right. It's cash inflow. So this is what the sensitivity analysis is. Okay, students. Now the last part, I will take just 2 more minutes to wrap up this. The last technique is scenario analysis. Now, what is scenario analysis? Till now, we have studied the sensitivity analysis, right? Sensitivity is calculated for one factor at a time. But scenario, what will happen is we will be given, let's say, 3 different scenarios. Scenario 1, scenario 2, scenario 3. See, students, in sensitivity, we are only changing one factor at a time. Okay, wait. Shraddha is asking, how did we got 3.103? It is given in the question, Shraddha. 11% discounting rate is 3.103. What we have to do is we have to increase the discount rate by 10%. 10% has to be increased by 10%, which is 11%, right? So 11% discounting rate is 3.103. Now, in sensitivity, we have kept other factors constant and we have changed only one factor and seen the impact. But in scenario, we will be given the different set of inputs under the different scenarios. For example, in this cash inflow, cash outflow, discount, for example, it is 10, it is 2, it is 10%. Now scenario 2 will be, let's say, 12, 4, 20%, right? Scenario 3 will be, let's say, 5, 1, 5%. So if you see, there are different set of inputs that are given under the different scenarios and we calculate the NPV under all the 3 scenarios. That's all. That's called as scenario analysis. Thanks for the. Okay, students. Now after this, one question is left from the today's session, which is question number 9, which we will cover in the next session, or we can cover it in the revisionary class that we have kept it on Saturday, right? So with this, most of the things in this comes to an end, right? So what I request is all of you to please do revise the concepts and let's meet up in the next session on the dividends, okay? On the dividend decisions. So yeah, okay, thank you. Technical team, we can close the session.